In case you didn't see either the thumbnail or the title of this video, let me give you a quick little hint for what stock we'll be talking about today. Hey everyone, and thanks for joining me today. My name is Matt, and if you didn't guess by either the title, thumbnail, or my hint at the beginning, today we're going to be taking a look at Dropbox. Now before we get started with this I just have to say this is not financial advice. Please don't take this as financial advice. If you do have any questions or need assistance, please go find a financial advisor, as they'll always be happy to help. Give them a quick Google, give them a shout, and they'll be happy to help. This is just for your entertainment purposes only. So with that out of the way, also if you enjoy this video, hope you consider hitting the thumbs up button, turning it blue or whatever, since that's free, and so is subscribing. Just take them both into consideration. Now what started as simply just a file-based cloud storage sharing program in 2007 has now expanded into a much broader business, helping out many other businesses when it comes to communications and file sharing. Now I know, another workspace that we're going to talk about on this channel, but I think Dropbox has actually a little bit different of an advantage than some of the other ones we've previously talked about, like Slack and Microsoft. And I know for the longest time I used to wonder, what is Dropbox really going to do other than this file sharing system that they have? And I saw this graphic that I'll just put up on the screen so you could take a look at this with me and see all of the companies that they now work with. They call this an open ecosystem, or an open-ended ecosystem of all these other products and services that integrate very seamlessly with Dropbox. I'm going to start off by talking more about their earnings report and just their kind of annual updates about the company and the direction they're headed in. And I'll just run through this part relatively quickly. So total revenue is up around $470 million, and that was up around 16% from last quarter. They currently have about 600 million users globally. Now 80% of those global users, of that 600 million, use Dropbox for their business needs, which is actually something that I liked to see, or I was happy to see, because that means the majority of people that interact or use Dropbox use this as a need and not a want. So that's obviously going to have the ability to create longer lasting relationships. And again, it's a need. So if your business operates on this, it's not necessarily always the easiest thing to switch when you're using multiple of these different softwares or services. So again, I was a big fan of seeing that 80% of the users are using this as a need and not just a want to send pictures of their dog. Now, of that 600 million users though, 15 million are paid customers. Now, just so you understand how Dropbox does their marketing, is they essentially just try to upsell people. So they feel that if people start off using Dropbox, the free version, which is only like file sharing of 2 gigs or file storage of 2 gigabytes, then they just feel that's a good place to start. People will like it. It's pretty seamless and easy to use. I have Dropbox myself and I use the free version. And they think that when people use it and take it into their business, they might talk to their colleagues about it and say, hey, let me share this with you on Dropbox. And then all of a sudden, that one person got 4 other people involved on Dropbox. And then it goes from those 4 other people telling another 4 people, and it just has a trickle down effect from there, ultimately expanding it into big companies. So the reason why they have that approach is because it does minimize their marketing expenses, as well as they don't really need to hire a sales team. But 15 million out of 600 million really is a drop in the bucket. And I think that they really have a huge opportunity that they need to expand on and try to convert more people into a paid customer service. And maybe that would involve hiring a sales team, that we don't know. But I just feel that 15 million could really easily be upwards of, I don't know, maybe around like 50 to 75 million paid customers if they had maybe a little bit more marketing, advertising, or having a sales team go out to some of the bigger corporations. With that though, they do tend to focus on more small and medium-sized businesses. I'm a huge believer in small businesses. I love, going to the small businesses, and if I travel to a new town, I'm not going to go out to dinner at a O'Charlie's or something. I'm going to go eat at a local restaurant that you won't ever be able to experience anywhere else. And kind of a side note, personal note there, didn't really need to include that. But I do like that they work with these small, medium-sized businesses, because another reason is it's almost like they're going to catch them while they're young. So if a business is just starting using Dropbox, that's what everybody's basically grew up using within that business, and it's going to be very easy for them to just adapt that as their business grows. Once a small business of maybe like 10 people grows into a big company of like 100 or even 1,000 people, it's very hard, expensive, and time consuming to train people to use new services like a Dropbox if you were to switch over to like a Microsoft Teams. And so I think that it could be a real advantage for them if, again, they focus on these small businesses, hoping that maybe even just a small handful of them will eventually grow into a very large business, but still using Dropbox's service since that's what their business was built on. Now, as you saw from that open-ended ecosystem graph that I showed earlier, Dropbox is really focused on not reinventing the wheel, rather being compatible with other services that maybe their customers already use. So rather than trying to compete against companies like Microsoft, Slack, Zoom, Adobe, DocuSign, they just allow for the consumer to integrate those programs right into Dropbox. So it's also going to be a little bit more cost effective from Dropbox's side of not having to then build these brand new proprietary systems for people then to try to figure out, learn how to use and use their systems. And that's something that actually I really like to see, is that they, again, are not reinventing the wheel, rather allowing for people to very seamlessly integrate programs and services that they already are using. And admittedly, back when I did the DocuSign video, I was kind of debating between Dropbox and DocuSign, but I just didn't really find enough clarity as to the direction Dropbox was headed in. I really thought, I was like, it's a file sharing service, and apparently they're doing something with signatures. So what else do they really have? And what's going to say that just Microsoft or Adobe can't completely take over this company? And now that I started to see the integrations, it makes a lot more sense to me. And right now they have two main sources of revenue. Obviously, the first one being the subscription service for using Dropbox, and the other one is HelloSign, which is basically their version of DocuSign. And both of those have separate monthly subscriptions, and obviously they have varying levels between those. But I also like, and this is not a video on DocuSign, although I'm going to talk about them a few more times, but I like that they didn't just shut down DocuSign. Instead, yeah, they have their own service that I'm sure they would like for you to use, but they're giving their customers options, which again just makes this a very seamless transition from, if you need something like DocuSign, but you're using Dropbox, you don't have to keep scrambling around figuring services. You could just integrate it all together. I was curious to see if somebody needed Photoshop from Adobe, and that's one of the apps that you can include on your Dropbox page. I don't know if somebody signed up for an Adobe subscription through Dropbox, if Dropbox gets a percentage of that sale. I'm sure they do, but I couldn't find any information supporting that. So if anybody does know the answer to that, please leave that in the comments down below, because I think, again, that could be a really big opportunity for them to create some revenue. But with this being a subscription service, I'm all on board with that. So that got me really excited, again, just seeing that they now have a little bit more of an offering than what they previously had, but are still focusing on that core business. For this week, and we're going to just take a look at more of the basic numbers, and we'll get to the valuation after this part is done. You'll see that I am doing a comparison this week with two other companies. The first one being Box, which essentially is like Dropbox. And I don't know what it is, but I have, again, a huge problem with the name, kind of like I did with Nikola. Just because it's like Tesla's already around. Why would another electric car company come out as Nikola? Dropbox was already around. Why did this company say, oh, well, we'll drop the drop and just call ourselves Box? Pretty unoriginal, but from what I was able to tell, it's a very similar service or very similar value proposition to what Dropbox has. And also DocuSign. So DocuSign, again, a company I already did a Watch List Wednesday on. But I do feel that these companies, even though Dropbox allows you to use DocuSign, there's still a little bit of competition there, given that Dropbox also has their HelloSign feature. All right, so we have the PE ratios that we'll start off with, and as you can see, these are forward non-GAAP PE ratios. And we'll see here, Dropbox at 24.79, Box at 29.54, DocuSign at 383.84. It goes without saying that obviously it looks like DocuSign could be trading at a premium in the future, and I could see that as well, but with Dropbox being at 24.79, again, for a tech company, I'm happy with that number. EPS, I have to admit, since I decided that I was doing Dropbox this week, I was happy to see that Dropbox, and this is for the TTM EPS, was the only one that had a positive earnings per share. I was a little surprised to see how DocuSign obviously was doing the worst when it comes to an earnings per share basis, but I know DocuSign is also trying to expand and grow their business, so it's a little bit more justifiable. Beta, again, I was a little surprised I guess tech companies are basically becoming the market anyway, but I was a little surprised to see the 0.84. I thought they would have been a little bit more volatile than that, given how they're still very much a growth company. But happy to see that there's not that much volatility associated with a company that I feel still has a lot of room to grow. Obviously, Box is a little bit more volatile than the market itself at 1.41. DocuSign sitting right around the same spot, though, as Dropbox. So good to see that both of those companies, which in theory should be in the Watchlist Wednesday portfolio, are less volatile than the market because, as I've mentioned before, I'm trying to have a little bit more conservative of a portfolio. The revenue growth year over year. So revenue growth year over year. No, Dropbox's revenue growth is not like Shopify's is, or not like Etsy's revenue growth is. And admittedly, I wish it was higher like it is with DocuSign. But I think that, again, if they're able to start capitalizing on, growing that paid customer base from 15 million to maybe more of, again, like 25 million, 50 million, even 75 million paid subscribers, that would really help this revenue growth year over year. So I do see that as an opportunity, one that I would look for in the future to make sure that number is continuing to go up. EBITDA growth. Now, EBITDA is something that I've never really talked about before. So EBITDA is a non-GAAP measurement. We're in finance, not accounting, so we don't really care about GAAP and non-GAAP. But if you don't know, GAAP is general accepted accounting principles. And EBITDA is just like you would think it is: earnings before interest, taxes, depreciation, and amortization. So a GAAP measurement is EBIT, earnings before interest and taxes. This just includes the depreciation and amortization. You can look up amortization if you don't know what that means. That's a whole nother conversation. But as we can see, I really only included this because I was very impressed to see this. And unfortunately, I didn't see the EBIT. I didn't really take a whole deep dive into looking for it, but I was very impressed to see that Dropbox, not only is it 63.2%, but compared to Box and DocuSign, they're the only ones that are positive. DocuSign, negative 27.81%. Box, negative 60.07%. That's rough. That is pretty rough to see. Now, they might have some big expenses, or maybe they're paying a lot in taxes or interest for something. Maybe they have a lot of debt paid out. But again, I just thought it was very impressive to see that Dropbox was positive and by a huge margin compared to these other two companies. And similar here. So the net income margin, when I first took a look at it, I was a little upset because I think like their gross profit margin is up around 75%, but the net income margin was 1.85%. So that is ultimately why I'm actually doing the comparison to the two other companies, just to help paint this picture, because both Box and DocuSign also had very similar gross profit margins around, I think it ranged between like 68% to 76%. Don't quote me on that, between the three of them. But as we could see here, Dropbox is the only one with a net income margin that's positive. The other two are both negative, and part of the reason why I did decide to look at why I did decide to look at Dropbox this week is because, yeah, it's been on my radar for quite some time now, but they also just very recently became profitable. And you guys know me, I like companies with minimal debt and are profitable and have a strong future outlook. And hey, if we can hit all the check boxes, hopefully they'll be undervalued as well. So far, things are looking really good for Dropbox for me. Lastly, the quick ratio. Again, it's over 1. Great to see, because as a new company, they're probably going to experience some times where they need to either take out debt, raise money through some kind of funding round or something along those lines, just to help their business grow consistently. And so just seeing that they have a quick ratio of greater than 1 is a good sign for me, because that should, again, in theory, help them when it comes time for them to take out a loan, or if they need any kind of special financing for future projects or growth. All right, so now just quickly here for the valuation. So again, I'm using Simply Wall Street's valuation. If you're wondering what method they use, it's free cash flow to equity for this one. They use like a 2-stage valuation process. So using that method, and it's the one that I feel is appropriate for Dropbox as well. You could also do free cash flow to the firm, but I do believe the equity is a better representation for this company. And as we could see here, they did calculate that their fair value is around $23.51, making that give or take about 18% undervalued. Depends what it's trading at right now. I think it's a little bit higher than $19. So, 18% sounds like a lot of room for growth, but also $4 doesn't sound like that much of growth. So it is one of those companies you'd probably have to be able to buy a very large portion of in order to really experience that growth. But that being said, obviously there's an opportunity to grow. And personally, I really think Dropbox could be one of those companies, maybe not next year or even the year following, but I could see it maybe trading upwards around $40 to $60 a share is something that, just thinking with all numbers aside, I would anticipate how much Dropbox is worth. So obviously it's undervalued. Usually a lot of people look at that and think that's going to be a great opportunity to buy. I tend to think that way as well, but just a few other things I wanted to point out. First is, I'll take a screenshot of this so you guys can see this as well. I just think these graphics give an easier visual representation to where the company stands. This one's pointing about their assets versus liabilities. And as we could see, their short-term assets is enough to cover their long-term liabilities as well as their short-term liabilities. So they're in a great spot financially, and that means that, to me, I see that as somebody with a very healthy balance sheet. The last thing I wanted to show you before we kind of move on to buying this is I would just like to show this ownership breakdown. So it's something I've talked about before. I don't think I talk about it enough, but basically 57% of the shares of Dropbox are owned by institutions, meaning they're owned by companies like Schwab, Vanguard, Fidelity, and they hold all of these positions inside of their funds or ETFs, so mutual funds and ETFs. That is something that I very much like to see, and part of the reason why I'm not a huge fan of IPOs is because when it's owned by an institution, they're going to hold on to it longer than a high-frequency trader would, meaning that it's not going to have as much price volatility because the trade volume should be lower, given that more than half of the stocks are owned inside of these big institutions. So, and just to say why I don't like IPOs, or, one of the reasons why I'm not a huge fan of IPOs is most of their shares have not been picked up yet by institutions. So yes, they have lockup periods where the insiders can't sell large amounts of shares right away, but at the same time, a lot of people get in and out of IPOs very quickly because they get into it, it takes a dip, and then all of a sudden they sell out of it. Next day, look at Beyond Meat, shoots up like 400%, then everybody wants back in, keeps driving the price up, and just by their nature, they have a lot of volatility. And so basically what I'm getting at here is looking at the ownership breakdown is a good way to see, or a good metric maybe to follow for how volatile the stock will be. Yeah, trading volumes is going to show you that as well, but again, just another place for you to look, because I'm a big believer in you should be looking at multiple metric or data points as opposed to just looking at like a PE TTM ratio that you see on Yahoo Finance and be like, oh, 15, I'm going to buy. I think it's important to just look at a lot more than that to really get a good idea for if the company is a good investment. Long way of getting to, I like this investment. It's what I'm going to add to the portfolio. All right, so here's the portfolio. And again, hopefully this works. I was getting nervous when I switched between filling my computer screen and whatnot. As you can see, we do have Dropbox in the portfolio here. Now, when I said that we had a lot of room to grow, or you need to buy a lot of shares to really see that big growth, if it's only a $4 gain, I went ahead and bought 150 shares. So I could have bought more, but admittedly, we only have $2,000 now after this purchase in the account. So I put in around $2,904 into this position because I realize I'm taking on a lot of risk here. I realize this is probably not going to be a popular position either. I'm sure a lot of you will not like me adding this to the portfolio. But it's one I've really thought about for so long, and the whole time I've been thinking about it, it really hasn't moved. So that could be a downfall, but we'll just have to see, because I think Dropbox is really creating a good value for the consumers that actually use their product. And I'm a big fan of this integration. Again, rather than trying to reinvent the wheel and go head on with all these other companies entering this space, they said, no, you guys can just kind of help us out. We'll help you out. You pat my back, I'll pat yours. That sounds weird. That's definitely not how that phrase goes. But anyway, I just think that they are taking a little bit of a different approach towards this, workspace environment, which is obviously going to be a very rapidly growing industry. And their approach is one that I think makes a lot of sense. Again, by not trying to compete with anybody, not trying to create their own proprietary stuff that's going to cost them a lot of money, just saying, hey, let's all work together and let's make this happen. And that's just something I'm a huge fan of. So for that, I bought 150 shares. Again, portfolio's up. We now have Dropbox. Risky investment? Absolutely. But one that I'm excited to have, and I understand many of you might not like this purchase. I'm a fan of it though, so I'm excited to see what happens with this one. Hopefully it'll do better than Monster. Well, that said though, I hope that you guys all enjoyed watching this video. If you have any questions, if you want to tell me why I shouldn't have bought Dropbox, or if you have any other stocks that maybe we should add to the portfolio with the remaining $3,000, give or take, please leave that in the comment section down below and I'll gladly take it into consideration. Also, let me know if you just have any questions on stocks. It doesn't have to be a Watchlist Wednesday video. I'll gladly do a review of the stock like I did with Slack. If you did enjoy this video though, I hope you consider giving it a thumbs up. And if you haven't subscribed already, which again, 85 give or take % of you have not subscribed, I just hope that you consider doing so because it's free. Only thing it costs is just that 1 second of your time to click the button, so take it into consideration. With all that said though, I am wrapping up here, so thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world, but you're right here with me, and I really appreciate that. I'll let you go ahead, enjoy the rest of your day, and I will see you next time.